if you're writing November 24 examination, of course you would be at the exam hall by now, but even after the exam hall, don't come back and watch this particular video. Do it after your exams are over. And if you find this solution to be helpful, do like the video, do subscribe to our channel. That will keep us motivated. I hope the audio, video as well as the screen is clearly visible. So in this video, what I'm going to do is I have prepared the detailed solution of the descriptive question or the non-MCQ questions, I would say, and I'll be discussing the solutions. If you have any questions, if you have any different opinion, if you feel that no, this is not the way, this is how it should be, you can feel free to comment in the chat box, and we'll have a healthy discussion on that appropriately. This solution, the PDF that I have created, I will be uploading it in the resources section, suggested answers section of our app and website. I will also be providing the link of this particular solution as in the comment box and also in the description. So without wasting much of time, let us start off with the questions. The first one was on consolidated financial statements, H limited and S limited. Standard items, property, plant and equipment, financial assets, investment in S limited 5,800, this gets eliminated. Then 1,000 debentures in S limited 1,500. Now this 1,500 is 1,500 lakhs. Okay, so this actually is 00000. This is the number, right? And this is debentures in S limited because it is intercompany. Debentures, intercompany loan given and taken, this has to be eliminated. Now the challenge that comes, especially in terms of number, is that here debentures of 100 each is 3 lakhs. So face value is how much? 100. So if I do 1000 into 100, the number comes 1 lakh. Okay, there is some drafting error in this question because the face value is 1 lakh and we are saying cost is 1,500 lakhs. So basically 1499 becomes the loss. Okay, now that is the number which is given, so that is how we will be doing it. Then you have trade receivables 160 lakhs due, and here you have trade payables 120 lakhs due. In the adjustment they have said that 40 lakhs is in transit, so that you will consider. Okay, dividend receivable they are saying 320. Here they are saying dividend payable 400. So 400 into 80% if I do, I get 320. This 320 and this 320 gets eliminated. Whatever is payable to NCI, balance 80, that is what we will be showing, right? Then you have other liabilities, all of these are there. Then equity share capital, standard thing. On 1st of April, they acquired, S Limited had 400 shares of 10 each, so this is 4,000. This is on the date of acquisition. 3,000 lakh in retained earnings. So 4,000 plus 3,000, 7,000 is the total. They acquired 80% share with a consideration of 5,800 lakhs in cash. So basically you have the net asset numbers, 5,800 is the consideration. Then the following changes in the identifiable net assets as on 1st April are to be considered for arriving at the fair value of net assets and to record the changes in the fair value on the date. Okay, so if you see PPE and inventory 2,500 to 2,800 plus 300, 500 to 200 minus 300. So net the impact of fair value changes is 0, but you have to definitely present it. Then on this 300 you have to charge 10% extra depreciation for the year. And about this inventory, there is nothing given in the question. They have not said whether this inventory is sold or not sold. So we'll go with the assumption that it has not been sold. So if you have taken the assumption that it has been sold, then also it is okay. But because nothing has been given, we'll assume that this is not sold. And this is in line with some of the adjustments given in your questions in the study material and past exam papers. NCI is measured at fair value based on purchase consideration. Means what? With this 5,800 we have acquired 80%. What will be the value of 20%? Okay, so that is what we have to do. Then goods worth 200 lakhs to S Limited on credit at a profit of 20% on sales. 50% of the goods were still lying unsold. So we have sold 200 lakhs. Now this 200 lakhs, when they say worth, is it cost or is it sale value? Again, that is slightly not clear, but sold goods worth 200 lakhs means we'll assume this is the sale value at a profit of 20% on sale. So into 20% if I do, I get 40 of profit. Out of this 50 is unsold, so I will take only 50% of that and I'll get 20 of unrealized profit, right? Then they should have taken 40 lakhs, this we have already discussed. Dividend payable represents dividend declared out of pre-acquisition profit. H Limited credited its share of dividend from S Limited to its profit. Okay, so it is out of pre-acquisition and they have credited to their respective P&L. Now, the thing that you have to keep in mind, especially for this dividend adjustment, you can do it both ways. One, you reverse the dividend impact and do the solution. right? Like you do when there is a mid-year acquisition, or you ignore this dividend adjustment, your final answer will not change. Both the approaches are possible. So let us look at the solution. I think some issue with this file, just a moment. Some issue with the file, just give me a moment. Some issue in extracting. Yeah. So first one, calculating the net assets. 4,000 lakhs is the share capital, retained earning 3,000 lakhs, machinery fair value adjustment 300, inventory minus 300, total comes to 7,000. Calculating goodwill, purchase consideration 5,800, 1,450 is NCI, total is 7,250. Net assets 7,000, so goodwill becomes 250. Impairment is given as 100. If I remember, I think we missed that point. Goodwill has to be impaired by 100 lakhs. So this information is given to us in the question. So why is this? Yeah, now I think it will be easy. Yes, this is what I wanted. Sorry. Okay, so impairment is 100. Now because the goodwill NCI valuation is based on fair value, this will be borne by both parent as well as NCI in 80/20. Carrying amount of goodwill is 150. Then as far as post acquisition profit is concerned, I told you there are two approaches. One is you adjust the pre acquisition dividend from the opening balance and arrive at what is the profit during the year. So 3,000 is what is given, 400 is dividend paid, so 2,600 becomes the balance, 5,000 is the closing balance in the balance sheet, so 2,400 becomes post acquisition. From there you will adjust the additional depreciation of 30 and you will get post acquisition for consolidation 2,370. That is one approach. The other approach is completely ignore this 400 of dividend pay and do the working. The final answer in both the cases will be the same. Okay, that is one. Or otherwise you can prepare a ledger where you can say balance brought down is 3,000, dividend paid 400, balance carried down is 5,000. So 5,400 minus 3,000, 2,400 is post acquisition profit earned during the period. Okay, so either way you can do this or you can do the other way which I will be discussing later. 2,700, 1896 is parent share, 474 is the NCI share. Unrealized profit on inventory 20 we have already calculated. Now this H has sold to S, parent has sold, so we will adjust from the consolidated earnings or retained earnings of parent only. NCI balance as on 1st of April 1450, this is based on this calculation. Then sharing post acquisition profit 474 from the from the second working note. Dividend declared 80. Now this dividend declared we have reduced here because this is the amount that is payable to the NCI. Now why have we deducted here? Because here while calculating the post acquisition profit we have adjusted the dividend impact. Okay, because we have adjusted the dividend impact, in a way we have said, just understand this logic, in a way what we have said is my retained earnings as on date of acquisition is 3,000, my post acquisition profit is 2,400, so 5,400 is what I am considering while doing all the calculations. But Out of this 2,400, 400 of dividend has already been paid. So because this dividend has already been paid and it should not be in the retained earning balance, I have reversed the impact of that. That is why I am separately reducing the dividend that has been declared. If I don't do the dividend adjustment here, which I will show you separately in a different working note, then this adjustment is not required. Then goodwill impairment 20, closing balance 1824. Right? Then consolidated other equity, your retained earnings, balance from H limited 16320, post acquisition share 1896, unrealized profit 20. It will only impact the parent because parent has sold. Right? Goodwill impaired 80. Dividend from S320 I am reducing because I have already considered this in post acquisition profit of S limited. So if I don't eliminate this, it becomes double counting. And this 1499, I think a lot of you would have had a concern while doing the calculation, but because it is given as 1500 is the cost and face value is 100, so 1000 into 100 is 1 lakh divided by 1 lakh. If I do, I get only 1 lakh, so it becomes 1499. So closing balance becomes 16297. Now consolidated balance sheet, very easy. Holding plus subsidiary plus adjustment. Now here adjustment is 300 minus 30. Inventories 320 minus 300 of fair value adjustment and minus 20 of unrealized adjustment. Trade receivable 160, that is the intercompany balance, and 40 is your cash in transit. Then equity share capital of parent, this comes from working note. 13% interest 2999 because out of 3000, 1 lakh I have written off. Trade payables 2180, adjusting 120. Dividend payable 320, intercompany 320 has to be adjusted. This is not here, this is actually here 400, and these are the liabilities. So 34880 is the closing balance. Okay, so that is it. The student who had said this, goodwill 150, 1824, 34800. Okay, so I got 34880. Whoever said this question paper, okay, so you will get at least out of 14 marks, 12 to 13 marks is in your pocket. Don't worry about that. Then question number 2A, this is on a written put option. Same question is there in the study material and also in the class we have discussed, of course. There it is a question on forward. Okay, and these numbers, they are given MTM, losses there also. The same logic, the first set of entries will be same. Only at the time of execution, there it is a forward contract. Here it is a written put option. Written put option means what? Put option means I have agreed to sell. Written put option means I have an obligation to buy. I have an obligation to buy. So accordingly, the last entry would undergo a change. Right? So second one. Before that, if dividend adjustment is not done, what you can directly do is you can take the date of acquisition reserves and date of consolidation reserves and say that this 2000 is post. Actually, technically, it's not post because you have 400 of dividend which is paid out of this date of acquisition profit. But still, if you have done this calculation, then also you will get the same similar marks because the remaining all adjustments would be same. The final numbers 1824 here, 16297 here, all of that would be same. This 2A is similar to illustration 16 from our class and illustration number 3 of comprehensive illustration from the study material. You can have a look at that. Then question number 2B, Spicy Limited is a listed company, prepares interim financial reports at the end of each quarter. Following information is provided. On 1st of April, they had brought forward loss of 620. Under Income Tax Act, no DTA has been recognized because they didn't see foreseeable profit in the future. Profit in the foreseeable future. Due to certain change in government policies, the company business turned around and it has reported quarterly earnings of 650, 360 respectively for first 2 quarters and 720 in the coming half, which includes 160 of loss. So basically 720 is after 160 of loss. So in Q3 you will have 160 of loss. And in Q4 you will have 720, this is loss, plus 160 of profit. Required to calculate the tax expense to be reported considering 25% and 10%. Okay, this is again a similar question from the material from our classes and also from a past exam paper. Right, so here earnings are given 650, 360, Q3 earnings negative 160, 880. So total earning is 1730. Out of that we have brought forward loss of 620. So 730 minus 620, you have 1110, that is the taxable income. On this you will apply 25% profit tax and 10% surcharge on this, so total comes to 305. So what is the effective tax rate? 305 divided by 1110, that is your, 305 divided by 1730, that comes to 17%, right? This is your effective tax rate. Now, why no impact of DTA given? Because deferred tax asset was not recognized in the previous period. So in the current period also, that reversal will not happen. So DTA impact will not be required. Okay. So tax rate is 17.67, which is nothing but your 305 divided by 1730. So that number comes to 305 divided by 1730. Yeah, 17.64 rounded off. When you are doing calculations on your calculator, if you have taken just rounded numbers, then these numbers will be slightly different because I have used Excel to do it. Okay. So 17.64, so this is the respective tax expense, this is the tax benefit, and this is the total tax expense. Right? Then coming to 3A, Ind AS 40 standard question which is there in your study material, we have done in the class, more on disclosures and all of that, so you can have a look at it with few number changes. Then 3D, Mahajan Limited has a block of assets with a written down value of 5 lakhs on 1st of April for 22 for tax purposes. The book value of the assets for accounting purpose is also 5 lakhs. So opening balance is same. Depreciation is on written down value of 20% per annum. So on 5 lakhs also 20%, on books also 24%. Of the entire block, asset costing 50,000 were sold for 1 lakh on 31st of March. You are required to compute the DTA, DTL, assuming tax rate of 35%. Now here, one thing is to calculate the carrying amount and also to calculate the tax base. Okay, that is the first thing. Second thing is, they are not told whether to follow Income Tax Act or whether to treat realized. So for example, there is a sale of asset. What happens to the gain? That is also not given. So the solution that I am giving to you is assuming that we have to apply provisions of Income Tax Act 1961, where while calculating depreciation, you have to consider the opening balance minus depreciation minus the sale proceeds. Okay, so whenever you calculate for the second year, opening balance minus depreciation will give you the carrying amount at the end of the first year. From that, you will remove the sales proceed and then calculate depreciation. That is my assumption. Okay, because that is what I thought would be a most logical assumption given the question that is provided. Okay, so considering that, this is just for a cross check. You don't need to do this part. Okay. Opening balance 5 lakhs, 20% depreciation, you get WDV of 4 lakhs. Then 80,000 of depreciation, that is the depreciation for the second year, and 32,000 of asset value that has been sold. Okay, so the carrying amount of asset that is sold is 32,000. So the carrying amount finally left is 2,88,000. So what I have done is 5 lakhs minus 1 lakh, 4 lakhs. 4 lakhs minus 80,000, you actually get 3,20,000. Okay, out of this 3,20,000, asset costing 50,000 on this date has been sold. Okay, so basically 32,000 has been sold. 50,000 into 80% into 80%. So 80% is at the end of the first year, 80% is at the end of the second year. So 32,000 is what is sold. So you get this is the carrying amount, this is the value after sale. If you want to cross check, you can just take remaining assets 450, 20% depreciation, you get 288, but this is not required for exam purpose. Okay, now how to calculate tax base? 5 lakhs first year depreciation, WDV is 4 lakhs. Now assuming the sales proceeds are first deducted, you get value of 3 lakhs. On this 20% is 60,000, so this becomes the carrying amount. 288 minus 240, whatever is the difference, on that you calculate DTL at 16,800. Then 4A, the next question, this is on dismantling, so I can directly do the solution. Expected cost of restoration is 6 lakhs, 0.735 is the factor, 441 is the present value. So you have to prepare this table, 441 each year interest closing balance, the last year number will be rounded off. Depreciation per year will be 441 divided by 4, 1,10,250. Capitalization entry 441. Interest expense as per this table, you can do it for every year. Then depreciation 110,250. Right? This one, a lot of students got confused in which value to be taken. Okay, so here there is a company which has offered a scheme from 1st of April of 21. Okay, according to the scheme, each employee has an option to purchase 250 equity shares of the company at 45 per share, provided the employee does not leave for 3 years, that is 31st March of 24. A lot of students incorrectly have taken 45 as the fair value option. This is the exercise price. This is the amount the employee has to pay to subscribe to the shares. Once 3 years are completed, an employee can exercise the option within 1 year, that is by 31st of March. Okay. Closing share price on stock exchange as at 1st of April 21 is 91 per share. Face value is 10. Oh, face value is given in the question. In the solution, I have written that face value is not given. Okay, so I missed this point. I'll redo the solution there. A register value has been appointed by the company who derived the price 75 using the Black-Scholes model. Okay, this is the fair value to be considered. There are 750 employees as of 31st March, 25 left, and further 35 are expected to leave. During 22-23, some company came, that is irrelevant information. 275 left and 135 are expected to leave. As on 31st March, only 400 remain. Only 400 remain means 350 left. Out of it, only 375 exercise the option to purchase the equity share during the year ended 31st March. Provide necessary accounting entries during the life of share-based payment scheme to account for the scheme implemented by the company. Now they have not told what happens to the balance 25. See, they have time to implement, choose till 31st March of 25. So they have not told what happens to balance. So one you can assume the balance 25 will exercise in the next year. You will not pass the next entry. If you assume the balance 25 will not exercise, then you will transfer the balance to the retained earnings. Okay. Or you can assume that they are exercised in the year ending 31st March of 25 and pass the necessary journal entry in that period. Okay. So let's look at the solution. 750, 25 minus 35, 690. 750, 300 left. 300 only, no? I hope I have taken the correct number. So 25 left and 275 here. So that is 300. Okay. 300 left, 135 expected to leave. This brings down to 315. Last year only 400 remains. Okay, number of options 250. Total options expected to vest. Basically 690 into 250. 690 into 250. 172, 500. Fair value per option 75 is what you have to take. So 172 into 75, this is the total fair value over 3 years period. Expense in the first year cumulatively should be 43 lakhs 12,000. Nothing has been recognized, so this is what you will recognize in the first year. Second year, it is down to 5906. Basically 250, 315 into 250, 78, 750 into 75, you get 59. 2/3 is only 39, 37, 500. So already recognized so much, so 375 has to be actually reversed. Then third year, 750, 400 are left. Your total of 75 lakhs. Out of 75, only 39, 37 has been recognized so far cumulatively. So balance 35, 62 has to be recognized. First year and third year, entry should be benefit expense to reserve 4312, 4312, 3562, 3562, and reserve to reversal is basically debiting these two numbers. Final balance will be your 75 lakhs. On exercise of the option, so here is an assumption that not exercised. Assumption. Okay. If you assume that if it is exercised subsequently, accordingly we will pass the entry. So we will debit SBP bank account by number of employees. Okay, I think that's an error on my part here. So mistake I have taken for entire 400 employees. My bad. Out of 400 in the question, they have said only 375 have exercised, right? Only 375 have exercised. See, even after doing it so many times, we get stuck. So, exercise of option will be 375 into 250 into 45. So, 375 into 250 into 45. That is, this is not the right number. This number will be 42 lakhs 18,750. SBP reserve is proportionate for 375 employees, right? And this also I didn't read it properly. Equity share capital face value 10. So 375 into 250 into 10, 937 500 will be to equity share capital. To securities premium will be minus 42 18750 minus 70 31 250. Okay, so the balance will be 1 crore 3 lakhs 12,500. 1 crore 3 lakhs 12,500. I'll still cross check this, in case I have missed the calculation. But this is the logic here. If you assume that they exercise in the subsequent period, again you will have a repeat of this particular entry. Okay, so here For most of you, if this table is right, you will score the full mark. If the table is right only for the first year, you will score only proportionately for that period. Then, this is another question. This is from educational material plus RTP in the previous period. Marketing company having its departmental store in class of city in India, and one thing is this is a 5-mark question and actually a pretty lengthy question. They say different products for increasing sales, they have some scheme. For every purchase of 400, 6 points is given. Each point is redeemable up to 3 years. Value of each is 0.6. During the financial year, the sales of the company is 150 lakhs. Now, if you do 150 lakhs divided by 400 into 6, you get 2,25,000 points, which is given here. 225 points have been awarded. So now 225 points into 0.6 is the total value of points. Out of the awarded points, 54,000 points will remain unredeemed as on 31st March. So 54,000 points will remain unredeemed, means they will not be redeemed, which means out of 225, if I do minus 54, okay, so 225 minus 54 if I do, I get 171. 171 has been redeemed in the current period. Okay, expense only 75%. So out of this 54,000, 75% will be redeemed in the future. As an accountant, you are required to search the accounting treatment and pass the consolidated journal entries in the following case. Now, let's see the solution. Total sales 1,50,000. Value of points 1,35,000. That is nothing but 2 lakhs. 225. 225 into 0.6. So if you do 225 into 0.6, we get 135. Okay. Then this is the total sales value. This is the total amount. Now this becomes the total standalone price. Out of this, the amount received is only 1,50,000. So 1 crore 50 lakhs. 1 crore 50 lakhs will allocate in the basis of the standalone prices. So 148.66 and 133.796 will be your respective sale. This sale will be recognized in the same year. Out of these points, whatever has been redeemed will be recognized in this year. Whatever has not been redeemed will be shown as a liability. Okay. Now, total points 225, total points unredeemed 54,000. Expected redemption is 40. So out of 225 minus 54 is what has been redeemed in the current period, and 4,500 will be redeemed in the next period. So the number that will be redeemed is 225 minus 54. This much has been redeemed already in the current period, plus 4,500 will be redeemed in the next period. Okay. Or if you want to calculate it the other way, what you can do is, out of this 54,000, 25% will not be redeemed. So 54,000 into 25% is 13,500. 13,500 will not be redeemed. So out of 225 minus 13,500 if you do, you will get total redemption 2,11,500. For this 2,11,500, my estimated transaction price or estimated sales price or the revenue is 133,796. Okay. Now, in the current year, for sale of goods, you will recognize everything. For the redeemed points, 171, what you will do is 133,796, the allocated transaction price, divided by 2,11,500, total estimated redemption, multiplied by 171, that has been redeemed. So what I am trying to say is 171,000 has been redeemed, or 1,71,000 has been redeemed. 221,500 is the total expected points. So total value divided by total expected points multiplied by 171, you get 108,175. This is the revenue to be recognized in the current period, and balance whatever is left 25,628 will be recognized in the subsequent period. So debit bank, credit revenue from redemption of points, and liability for loyalty program 25,620. Right. Then this one is a pretty straightforward question. They have adopted Ind AS. The first thing is, as a part of PP, property, plant and equipment, measure land at fair value. Can they do that? Yes. So this 6 lakhs will be the value at which they will be recognizing. 5 lakhs is the existing amount. So the difference of 1 lakh, you will take it to retained earnings. Then they have taken a loan from another entity. They have interest rate of so much. They have incurred transaction cost. It was carried at cost. Principal amount is to be repaid in equal installments. Interest is also payable at the year end. Fair value of the loan as in the rate of transaction is 280 as against the carrying amount of loan, which is 3 lakhs. Okay. Now, management wants to know the impact of Ind AS in the financial statements of company in general for general understanding. Prepare Ind AS impact analysis report extract for Z Limited for presentation to the management, wherein you are required to discuss the corresponding difference between under GAAP and Ind AS against each identified issue and its impact thereupon for preparation of transition date balance sheet, also pass the journal entry for each of the things mentioned above. So here, basically what are required to do? Plant value will increase by 1 lakh credited to retained earnings. Second, loan is carries transaction cost, then principal amount is to be repaid in equal installments over a period of the loan, interest is payable at year end, fair value is 2 lakh 80 as against the carrying amount of loan, which is 3 lakhs. Now here, if the management finds it difficult to estimate or to calculate effective interest rate based calculation by giving a retrospective effect, they can take the fair value on the date of transition and record the journal entry or record the liability. So 3 lakhs to 2 lakhs 80,000, 20,000 reduction, that is what can be done. So loan will now be shown at 2 lakh 80,000, which is the fair value on the date of transition, and the difference of 20,000, that is reduction in liability, will be credited to retained earnings. Okay. Then offsetting. So let us see the offsetting thing that we can see the solution. The first one, can we offset the gain or loss? So this is actually from article number 21. Okay, so you can offset it, but if the gains or losses are material, they have to be disclosed separately. Then if there is an agreement between holding and subsidiary, if it pertains to reimbursement of expenses, you can offset it. Otherwise, if it is not an actual reimbursement transaction, it is more like, let us say, I incur the expenses and the subsidiary actually, I bill the subsidiary and I'm charging revenue for that, or I should be treating that as a revenue, then in that case it should not be done. And in the third case, when there is a receivable payable from the same party, okay, you should be reported separately unless offsetting reflects a substantial transaction. And as per Ind AS 32, financial asset and a financial liability should be offset if the entity has legally enforceable right to set off and entity intends to settle on a net basis or realize the asset and settle liability simultaneously. So if I have the intention, if I have the right to offset, I should be offsetting. So then I can present it on the net basis, otherwise no. Now 4-mark question, don't expect to write so much, just give whether offsetting is allowed or not with a brief reason. Question on accounting and technology is a replica of study material question as it is given. I don't know how many of you would have remembered that question. Then coming to the revaluation part, again a very simple question. Okay, in the revaluation question, we had a revaluation surplus of 60,000. If you just quickly see the question. Lakhs 160, net carrying 240, 3 lakhs is the value. So 60,000 is the revaluation surplus. So 160 first you will offset it against the gross carrying value. You will get the value of 240. Then you will add 60,000 to the revaluation surplus. Okay. You are required to advise how the company would account for revaluation of plant and machinery and depreciation subsequent to revaluation. Past journal entries in relation to above. Okay. So first, accumulated depreciation to property, plant and equipment. Okay, so that is the transfer. Then debit property, plant and equipment, credit revaluation surplus 60,000 for revaluation. Subsequent to that, 3 lakhs divided by 6, 50,000 with the annual depreciation with the following entry. Okay. Then there is a question number 6C, right? Whether a particular item is a prior period error or it is a change in estimate. Now this is as per looking at the question. First, they have said management estimated that wages are not required to be paid. So we felt wages are not required to be paid. Subsequently, court came and said you have to pay the wages. So then this becomes a change in estimate because we didn't have any information on the balance sheet date that the wages will be required to be paid in the future. It is a new development. Then 1,50,000 which is omitted, it is a clear case of prior period error. Change in provision for doubtful debt, it is again based on estimate, and subsequently if new information arises or if we realize, we'll actually reverse the estimate. Then last one, insurance company, as per my understanding, we didn't know how much premium has to be paid, right? It is the insurance company that has to ask the insurance premium. If the insurance premium has given me the wrong amount, how will I have the information to pay the correct amount? So again, because the information was not readily available, I would treat this as a change in accounting estimate. Okay, if you have any questions, let me see if any of you have put any questions. Actually, I have not checked the YouTube live. This as a change in accounting. Okay, so no questions. Of course, a lot of you'll be writing exams, no questions as such. Thanks for joining in, and if this has been helpful for you to understand how to answer the questions, this of course in some time it will be available on our app. I'll give the comment in the link in the description as well as in the comment box. Okay, and you can download that, refer to it. Of course, once the suggested answers are out, we'll also have a comparison with how the institute has given the answers. Okay, MCQ, we have anyways done it separately. Thanks a lot.